Hi guys, welcome back to the show, and I think we've got Steve Benger. Steve, you there?
John, I am. How are you?
Good. How was Chicago today?
I believe it's going to be a beautiful day, like 60 time of day, which is pretty fantastic for us.
Wow. When do all the hot girls show up in Chicago? That used to always blow my mind. It was all winter. It's like you never saw anybody. All of a sudden
Well,
they appeared.
yeah, yeah. Well, I'm just glad you keep your eye on the ball.
Well, I was young then. That's all I thought about when I lived in Chicago. Hey, what's on your mind this morning?
Well, a lot as always, right? But I think it's a good
Awesome.
time to talk just because Trump is going to be speaking later,
Oh
and
yeah.
it's obviously interesting times for investors, I believe.
Oh yeah. So, um, where's the risky trade? Where's the non-risky trade when it comes to trying to trade the S&Ps and any type of volatility type situations? You think? Have you got any
Um,
strategies in mind right now?
well, yeah. I mean, there are a couple of things which come to mind.
Okay.
But it's all long-term play. So let's try to talk about the short term first. Obviously, market's done a huge move by, depending upon from where you want to measure it, it's up 15% from the early November lows,
Uh-huh.
and pretty much uninterrupted. So
I'll
technically
say.
speaking, from every perspective, it's definitely stretched, and it might have to pull back here at one point. Trump addressing Congress might be a trigger event, so I'm not so sure that I really want to be long into the speech. But in very general terms, obviously, the market looks super healthy. I mean, that thing looks like a rock. There's no question about it. I mean, the question is if he can deliver on some of the statements he has made in time for the market to stay afloat. And that's a risk I see. If he is unable to get some of the legislative agenda going within a reasonable period of time, a pullback becomes progressively more likely. And the two things which come to mind for that are tax reform and specifically corporate tax reform. And the other thing is Dodd-Frank reform, because both of those things, I believe, are powering the market up right now.
Yeah, no, I tend to agree. When do you think that? Uh, I mean, the market's got to worry about something. I mean, what would the market worry about? I mean, because all these things are kind of the release of capital engagements by the administration. But what do you? I mean, what do you think the market would worry about? I mean, would it literally be inflation? I mean, would that? I mean, because I mean, infrastructure projects, Dodd-Frank dismantling, regulatory kind of caps. I mean, what would the market worry about at this stage? Because all those are like market-friendly type things.
Yeah, well, I think the risk is that the legislative agenda might be extended out, so that the reforms which people are expecting to see might only materialize in 2018 or 2019, and that uh, the depth of the reform is less than what is currently being expected. But I want to say one thing to what you just said. I don't necessarily think it's just a regulatory issue. I think as it relates to Dodd-Frank, there's truly an argument to be made that it will boost earnings very, very significantly, because if the capital adequacy ratios are being taken down, right now it's 6%, is that
Hmm.
being taken down to 5%, which I think is very feasible, then that provides about 20 some percent growth in the balance sheet of banks versus the current status quo. So right now, banks can lever their capital by about 16 to 1 at a 6% capital adequacy ratio.
Hmm.
If they take it to 5, it's going to be 20 to 1. So it's a significant growth to be expected in bank business from that perspective.
Yeah, and you got to figure, like, whatever he says tonight. I mean, he needs acceptance, from people in general, I guess, and and the market is kind of a big barometer for him on how he's doing. And you got to figure he's not going to say anything that he's not going to pull like a Greenspan and say irrational exuberance, if you know what I mean. I mean, he's only going to say things that are going to, people are going to like as far as the market goes, I guess, in my opinion.
Well, I mean, the funny thing is what he does say is very, very positive for the market. I mean, most people don't necessarily fully realize the depths of what the tax reform might mean to corporate earnings. And quite honestly, I was a little bit slow to catch up to that too, but it is really significant. I think it's the single biggest event we have had in corporate corporate governance in the past 30, 40 years. I mean, if he comes through with a 50% cut in corporate taxes, things become feasible for corporations to do domestically here in the United States, which are currently not feasible. I mean, it's a huge thing.
Right. So what do you feel, the biggest kind of hot point for him has been currency manipulation, or at least in the platform, the stump or whatever he was using to get elected. What do you think is the answer to that? Because that is, a factor in manufacturing and things like that, onshore especially. So where do you think that could be, the kind of upsetting event? But what are your feelings on the dollar?
Well, the dollar is going to get stronger. That's how I feel about it. And it's not necessarily because he talks it stronger. I think that the U.S. economy is going to do comparatively better than pretty much anything else out there, in particular when he follows through on some of the reforms. I also think that we're further ahead in the economic growth cycle than Europe is, which means our interest rate's going to go up faster than theirs next year or this year. So the interest spread is going to widen. And between those things, the dollar is going to be the strong currency. So he can talk about other currencies manipulating their levels all day long. But I think the reality of the game is that dollar strength is going to be a homemade problem, if you want to call it. I don't necessarily think it's a problem, but I don't really see how he can do anything about it. And I'm pretty sure he knows that too, actually. But I just want to talk about the banks one more time, because I don't necessarily agree with what you had said a moment ago, and I hope that's okay with you.
We argue all day long. That's totally okay. I'm used to it.
I mean, because you did ask me earlier when I first came on what are the good trades, and I actually believe that the banks are the one you want to be long. And I already talked about the ability to increase the balance sheet because of potentially less capital requirements originating out of Dodd-Frank. But the other thing is that we are entering a period of higher interest rates. And banks have been so low in their, well, why don't we talk about it after?
Great. Guys, we'll be right back.
Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's Nadex.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors. TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com. Larry Pesavento has just started his brand new service, Fibonacci 24/7, and he's already delivering content to his subscribers on a daily basis when the market's opened and even on weekends. Each Monday, you'll receive Larry's written report that provides detailed commentary and a summary on the charts and videos that Larry sends out. And throughout the week, when warranted, Larry will send out via charts or videos or both the key markets that he is watching during the day. This will be up-to-the-date, active trading information that will help you in your daily trading. In Larry's first week alone, he sent out 25 charts, 6 videos, and a full report to his subscribers in just 1 week. If you're a technical trader that uses patterns and retracements to trade, then Larry's service Fibonacci 24/7 is something that you must try. Right now, new subscribers can get a full 30-day money-back guarantee. With nothing to risk, sign up now to Larry Pesavento's Fibonacci 24/7 by visiting the front page of TFNN.com under Trading Newsletters.
This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
Hi, guys. Welcome back to the show. Steve, you still with us?
All here.
Great. All right. So you were... Continue, please.
That's right. We are talking about banks. Oh, that's right. So I had to think about it for a moment. So the reason why I believe banks are a buy outside of the potential ability to lever up their balance sheet a little bit more is that we are currently projecting 3 rate hikes for 2018, and banks obviously live and die by what's being called their net interest margin. And on $1 trillion worth of assets, if their net interest margin increases by 100 basis points or 1%, they would make an additional 10 billion. The way things are right now, we don't even have a lot of banks. I think we have 3 banks which make more than 10 billion. So there's tremendous leverage in earnings for banks if they are able to grow the net interest margin. And I think we are finally in an environment where that might actually happen. So I think it's completely feasible, even for smaller banks, to grow earnings north of 50% over the next 12 to 18 months.
God bless. Ooh.
It's a huge
that is a big catapult forward for sure. No,
there's a huge multiplier on that right now. But it's also only because interest rates are still historically lower, right? I mean, we are coming from historically low levels of interest rates, and at any other moment in time, a 75% increase in the Fed fund rate would not have that impact. So it's a very unique situation for banks right now.
Well, let me ask you this. All things considered, everything you said, and banks knocking the skin off the ball and everybody getting put to work and infrastructure projects and everything else, why are the treasuries not going down more? I don't understand this. I mean, like, why are these things looking like they still have a bid in them right down here? I mean, it's not like you're the only person who kind of uncovered this mystery, if you know what I mean.
Yeah, I mean, there's obviously a disconnect right now between the stock market projecting significant earnings growth and the treasury market kind of like stalling out, or like forming a base here, if you want to call it a base, or at least trending sideways. And I mean, we have seen that over and over again over the past 20 years, right? That the two markets don't necessarily seem to reconcile each other, and at one point something gives. And I believe it's just that situation again.
Do you think the way to play that then is to just kind of put on a big short and put a hedge on, and when it happens, or like, then just kind of wait it out and not necessarily get caught up in the herky jerky stuff that's going on now, or actually the bid that's going on now. It's just, I don't know, buy the lottery tickets on the south side and maybe do September puts or something like that, or.
I don't think you can trade the two against each other. I mean, if you want to do, let's call it a hedge trade, I would do something like banks long and retail segment short. Because the retail segment,
even at this stage, with where these things have gone, like, is that trade still valid?
Yeah, I mean, so the reason why I'm kind of like bearish on retail in general is that the retail segment is exposed to interest rates in their consumer lending operations. And if interest rates go up, they're going to get hit on that side. So if you look at Target this morning, Target missed earnings and revenues, not by much, but a little bit. And Target is usually one of the companies which is known to be the best executor in the retail game.
Yeah,
so
really.
if they miss, there's something amiss, right, within the industry. So if you want to do a long-short trade, that might be one. Retail short, banks long.
Still valid trade. Man, I mean, I was just looking at the banks run and the retailers. Almost the whole model. I mean, has to be rethunk. Is that a word? Rethought and is it worth it to have the shiny edges out front and all that kind of jazz, or just go to like almost like a Chipotle type model for retailers, like no waitresses, waiters, and all that. You just kind of come in, they slop it on your plate and you leave. I'm just wondering if that is kind of, do these things consolidate all these retailers, or how do they get out of this mess?
Well, that's a good point. I mean, who knows? I mean, I think the answer is that footprint has to be.
Do they turn their stores into mini casinos, or what are they doing?
I don't know. Who does that every corner?
Well, I mean, Trump. Trump's a casino guy. That's why I'm saying that.
Yeah. I don't. I mean, retail obviously has its own set of homemade problems, and shrinking of store footage is definitely going to be happening, and will continue to happen. In order to combat the quagmire.
Yeah. Somebody's got a question in the den. I just want to shift to this because I forgot to ask you earlier, or forgot to discuss this with you. The debt deadline coming on March 15th, the debt limit deadline, is that even something? I mean, that's just been raise it, move forward, raise it, move forward. I mean, does anybody give a crap about that anymore? And, are Trump's numbers going to finally come out? And, because every politician, as you know, kind of thinks they're always going to make it up later by doing something now that's going to affect that later in a good way as far as the debt goes. But what are your thoughts on that? Does anybody care?
Well, I think the answer to that, it doesn't matter until it matters, right? And I'm not trying to be cynical right now, but
I thought it was going to matter at 10. I thought it was going to matter at 10 trillion, so I'm kind of wrong at 20, doubling it. So go ahead. Sorry.
I think it's kind of like opening Pandora's box talking about it, because there's so many things to consider. But in terms of the actual act of raising the debt limit and having a hard deadline, I'm trying to remember, when was it, like 3 years ago, when we actually missed the deadline and we kind of like went to government shutdown mode and the market really took it on the chin there for a little while. So at that point, it obviously mattered, because nobody at the end of the day wants to see government shutdown and government being unable to perform. So from that perspective, the March 15th deadline does matter, because if you don't have something in place by then, or within a reasonable period of time right after, the market is going to be in trouble. And that might very well be the event which is going to push the market down. So from that perspective, I actually think it's a very viable question, because you asked earlier, what can be a potential trigger for a downside correction? March 15th, definitely the case. In terms of actual amount of debt which we have, And I hate to say that because I'm a big fan of no debt or less debt, but I don't really think the market cares. And I don't
You,
really see anything which will make the market care over the long run.
you know what? Everybody overseas too, like they can't really point a finger, at the United States and go, "Wow, your debt now is 1 point blah 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 whatever GDP, and $20 trillion is almost impossible to pay back, all right, or to cover." But they
Yeah, it's
can't
just
say anything because it's the dollar may drop and then they're screwed anyway, because they can't sell goods here. So it's that's a weird situation. Can you hang out for the last segment?
sure.
Great, thank you.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
Hi, I'm Steve Rhodes, host of the Trader's Edge, heard daily at TFNN.com and author of Mastering Probability, a daily investment and trading newsletter service that I send out each morning by 8 a.m. My morning newsletter service covers exactly what the markets have been doing since last night's close, providing you with an edge on your trading day ahead. You get actionable trading ideas, including the exact entry, stop, and profit targets. Plus, I'll teach you the patterns and hidden market correlations that will make you a better trader. As a subscriber, you'll gain access to my 90-minute money management workshop, where I'll teach you the secrets that'll save your assets. The bottom line, I've got your back, including a 30-day money-back guarantee. See for yourself the type of analysis I provide each trading day by signing up for Mastering Probability today. With nothing to lose, this is an offer you should not pass on. Mastering Probability can be found under Trading Newsletters on the front page of TFNN.com.
Catch Larry Pesavento, a 40-year veteran trader. He uses pattern recognition, Gartleys, butterflies, ABCs, and Fibonacci in order to trade these markets. Trade what you see. Next on TFNN.
Hi guys, welcome back to the show. And I just want to show you my new girlfriend here. She's about 7 days old. Rhode Island Red, Steve. I don't know if you can see that. All right. I think we got a caller. Bob, are you there?
Yes. Good morning. Thanks for taking my call.
Yeah, you're welcome. What's on your mind?
Well, I just it's an observation. As I told the screener there, I do a lot of charting, and something that always been recently, it's sort of an enigma, is that in a stagger step formation, you see both gold and the dollar rising at the same time, stagger step. And my observation is that I think possibly we got a gold-backed currency coming.
What are your thoughts on that, Steve Benger? That's a deep one.
So the US dollar is a reserve currency and gold is a reserve asset. And there's a connection between those two because of their perceived value in uncertain times. So even though I might not necessarily see right now that we're going to have a gold-backed currency coming, there are enough people in the market who would like to see that for a variety of reasons, because we do live in uncertain times. So I think the caller is onto something as to why both are rising in tandem. And it doesn't necessarily need to be that it is coming, but I think the motivation of people to buy it is very much aligned, and that partially explains it.
Bob?
Yeah, it makes sense. And one reason politically I thought that it would add fuel to it is that it would be, they could jimmy it such that it could be fully acceptable through Sharia law for the Muslims. And I know the Ottomans had been going for, not the Ottomans, but in Turkey there were people who were pushing for the gold dinar and things like that. Well, if and I think the Trump administration would be the time to do it if he solidifies his politics. But that was just a thought, and I always look for resolution for these enigmas, and this is one that I came up with.
I love how you referred to the Turks as the Ottomans. That was cool. Well, Steve,
if I may say
one
thing, I actually think the caller is onto something as it relates to the fact that it doesn't necessarily has to be us who go down that route to give gold a very aggressive bid, because the gold market, by comparison to every other financial asset in the world, is rather small. So, like any economy of some size migrating over to a gold-backed currency would have a huge impact on the gold price.
Bob, is that?
Well, no, yeah, I'm just all ears.
Yeah, I mean, because one thing to consider is the size of the gold market compared to the money supply, the available money supply, money in circulation in the United States is so inferior that just backing the US currency by 1% with gold would push gold up to, I don't know, $3,000 an ounce.
Exactly.
Yeah, so there's a huge size discrepancy there. So I think it would be very hard for the US to really back the currency in gold, but other countries, very much so.
Steve, thanks for those comments. Bob, can you call back tomorrow? I'd love to actually discuss this a little bit more. We only had a couple of minutes here to get into this, and I was showing off my new girlfriend there.
Sure, this is the first time I've heard your show. I just happened to come back to TFN recently, and good show.
Thank you. We'll talk to you soon. Thanks, Steve.
Thank you.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns, as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
This
is TFNN.